Read backwards. When you research a company's financial reports, start reading on the last page and slowly work your way toward the front. Anything. But investing isn't about beating others at their game. It's about controlling yourself at your own game. Blessed is he who expecteth nothing, for he shall not be disappointed. The stock investor is neither right or wrong because others agreed or disagreed with him. He is right because his facts and analysis are right. As the Danish philosopher Søren Kierkegaard noted, life can only be understood backwards, but it must be lived forwards. People who invest make money for themselves. People who speculate make money for their brokers. The intelligent investor is a realist who sells to optimists and buys from pessimists. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. Those who do not remember the past are condemned to repeat it. The punches you miss are the ones that wear you out. Boxing trainer Angelo Dundee. You will be much more in control if you realize how much you are not in control. Invest only if you would be comfortable owning a stock even if you had no way of knowing its daily share price. Point 3. Americans are getting stronger. 20 years ago, it took 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. Henny Youngman. Abnormally good or abnormally bad conditions do not last forever. On the other hand, investing is a unique kind of casino, one where you cannot lose in the end, so long as you play only by the rules that put the odds squarely in your favor. A stock is not just a ticker symbol or an electronic blip, it is an ownership interest in an actual business, with an underlying value that does not depend on its share price. Obvious prospects for physical growth in a business do not translate into obvious profits for investors. While enthusiasm may be necessary for great accomplishments elsewhere, on Wall Street it almost invariably leads to disaster. All things excellent are as difficult as they are rare. You've got to be careful if you don't know where you're going, 'cause you might not get there. Yogi Berra. The heart of Graham's argument is that the intelligent investor must never forecast the future exclusively by extrapolating the past. The investor's chief problem, and even his worst enemy, is likely to be himself. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. Intelligence has nothing to do with IQ or SAT scores. It simply means being patient, disciplined, and eager to learn. There is no room in this philosophy for a middle ground or a series of gradations between the passive and aggressive status. Many. The fault, dear investor, is not in our stars and no in our stocks, but in ourselves. After all, the whole point of investing is not to earn more money than average, but to earn enough money to meet your own needs. Never mingle your speculative and investment operations in the same account, nor in any part of your thinking. The best defense is a good offense. Without a saving faith in the future, no one would ever invest at all. P. 535. Without a saving faith in the future, no one would ever invest at all. Day trading holding stocks for a few hours at a time is one of the best weapons ever invented for committing financial suicide. If you have built castles in the air, your work need not be lost. That is where they should be. Now put the foundations under them. But the intelligent investor has no interest in being temporarily right. To reach your long-term financial goals, you must be sustainably and reliably right. Through chances various, through all vicissitudes, we make our way. Analysis is concerned primarily with values which are supported by the facts and not with those which depend largely upon expectations. The analyst's conclusions must always rest upon the figures and upon established tests and standards. High valuations entail high risks. You are neither right nor wrong because people agree with you. Mutual funds are the ultimate way for a defensive investor to capture the upside of stock ownership, without the downside of having to police your own portfolio. The intelligent investor will remember the wise words of financial analyst Mark Schweber: the one question never to ask a bureaucrat is why. The future value of every investment is a function of its present price. The higher the price you pay, the lower your return will be. While people were drowning in data, knowledge was nowhere to be found. The intelligent investor realizes that stocks become more risky, not less, as their prices rise, and less risky, not more, as their prices fall. Investment must always consider the price as well as the quality of the security. An investment operation is one that can be justified on both qualitative and quantitative grounds. Is the stock market riskier today than 2 years ago simply because prices are higher? The answer is no. But the answer is yes. It always has been. It always will be. You have the luxury of being able to think for yourself. The individual investor should act consistently as an investor and not as a speculator. Unlike most people, many of the best professional investors first get interested in a company when its share price goes down, not up. Benjamin Graham was an American economist and professional investor. Graham is considered the first proponent of value investing, an investment approach he began teaching at Columbia Business School in 1928 and subsequently refined with David Dodd through various editions of their famous book Security Analysis. Thanks for watching. If you like, please share and subscribe.